If you ever thought about getting into investing, chances are that you thought to yourself, I wish I had some sort of framework. There must be some things that are more important, less important. I wonder how the best of the best are making their investment decisions. This video is for you because I read this book, 0 to 1. It came out in 2014, so quite a long time ago, but I picked it up last year again. And then I also saw Peter Thiel at the All-In Summit, and I've studied him and his investments quite a bit. When I picked up this book again last year, I realized what incredible gems are in there. In this video, we'll go through the investment aspect that he mentions in his book by going through Peter's investment framework. The popular Peter Thiel interview question is, what very important truth do very few people agree with you on? Now, this is not an invitation to throw something that is a little bit controversial at the wall and see what the response is in the interview. This is about really thinking deeply about the problems that we face these days and how solutions can be found to solve these problems that are unique solutions. In an investing context, this is about having a conviction about something. He says only by having a conviction and an opinion about a certain matter, you can really make a thoughtful decision. There is a fine line between the spray and pray method and diversification that makes sense. And Peter Thiel certainly leans towards more concentrated risk because he says investing in companies is not like buying lottery tickets, and spraying and praying, the strategy resembles a lot playing the lottery. And he says companies and founders are not worthy being treated like lottery tickets. They are trying to solve the problems of the future. So you should take a view on who's the winner and then back that company and make an actual decision based on your opinion and your conviction. Before we get to the actual investment framework, I want you to bear in mind that we are talking about startups here. We're talking about investing in very young companies. The book is called 0 to 1 because he's talking about getting ideas off the ground and into something that is a company. So we're not talking about investing into Apple or Tesla at this point. These companies certainly were companies that went from 0 to 1 at some point. This framework is not applicable when investing into public markets. You can certainly take away something, but that's not what it's meant to do. The first thing an investor has to ask is the engineering question. Can you create breakthrough technology instead of incremental improvements? And here we can already see how the difference comes in between investing into startups and investing into public companies, bigger companies, let's say. I was listening to a very good podcast called 20 VC that had Wayne Ting, the CEO of Lime, on last week. And they spoke about how, as a CEO, it was the incremental improvements that over time led to the success of Lime over the other micromobility companies. A startup, however, needs to have a unique engineering advantage that is a 10x on its competitors and not an incremental improvement. Selling a new service or product is going to be difficult enough because people will have to adapt and change from how they've been doing and solving that problem before. So offering a 10, 20, 30% improvement is going to be difficult. They're going to say, well, you're probably exaggerating on your numbers, so they're very careful on what you say. So you really need to stand out by offering like a 10x better product or service that will grab their attention and be like, okay, let me give you a chance. The next thing that investors should ask is the timing question. Is now the right time to start your particular business? And timing is not to be confused with a hype. When everyone is going into a particular sector and it's pretty unclear where that sector is going, then it's going to be very difficult to create a company that is unique. But it doesn't mean you shouldn't go into a sector even though there's a hype, because if you do it in a smart way, then the company can still ride out that trend. It's just a matter of playing all your cards right when there is such a hype. Counterexample would be if a founder has a brilliant idea, but there's just no technology to support that. I'm sure somebody thought of drones in the past, but it's only now that you actually have technology that can be downsized into this format. Next up is the monopoly question. Are you starting with a big share of a small market? I'm sure you've seen these company presentations where they always start with the total addressable market, and it's like this huge market, and they say, well, if we only can get a small piece of that, that would already be great, and our company would be already valued at such and such. But in effect, it's very easy to exaggerate your own uniqueness, and companies often fall victim to starting with a slide with a very, very big market and then adjusting that market size depending on how it fits them. The monopoly versus competition that Peter Thiel often refers to is less about building a monopoly like we think about in terms of a big company dominating an entire industry and these tycoons sitting in the back room and pulling levers. It's more about dominating through a superior product, a product that is so good that just by the fact that it's so good, it captures the entire market. And you start with a small market and then you expand to bigger markets. For example, PayPal started by focusing on eBay, offering online payments to these people who were suffering a trust issue because they were dealing on this platform. That way they could establish themselves as online payment providers, and only then they moved into a broader market. Now, the next question I'm sure you've already thought about. It's the people question. Do you have the right team? And in my experience, this comes down to two factors. First of all, the founder team should work well together. So a conflict among founders is usually what makes or breaks a business in the early days, because it's how the founder team harmonizes, how the different skill sets come together and become something greater by just playing on each other's strengths. That sort of makes or breaks the business. It's actually a lot less in the idea, in my opinion. It's much more in the execution, and in the execution, the team plays a major factor. And the second point is that if the founders have the right or wrong attitude towards building a business, so if they're doing it out of conviction, out of the belief that this is the right thing to do, this is a problem that they want to solve, and they believe in this problem-solving approach, then they will be successful. But not if they're just thinking about exit multiples and buying their first car, feeding their family because they're now financially free. That can be a motivator. It's not the best in my opinion. Coming up to question number 5, which is the distribution question. Do you have a way to not just create, but deliver your product? Now, the best product is no use to anyone if it's just in your basement and there's no way to getting it out. I believe that YouTube and other platforms have really come in and democratized this problem and the marketing around even very small niche products, because you can show on your channel how you built the brand that you're building, and that makes it a lot easier for people to know about your product and share your product. Still, logistics is a major factor, and if you have a bulky product that is not of huge value, but you have very high logistical costs because it's so big related to the value, then that's a big problem, because quite literally you're going to be stuck with it and there's going to be no way to efficiently move it around. That's so insane about iPhones. I think about that from time to time. They've reduced the box the iPhone comes in by so much, and it's just this little box that is worth over $1,000. That's crazy when you compare it to a crate of beer, for example, that costs $15 to $20. Next up is the durability question. Will your market position be defensible 10 and 20 years into the future? I like this question a lot because it really forces you to think long term. And as Graham Weaver says, doing it for decades means that you're going to be successful, but you have to, things always take longer than you think. So you have to factor in a lot of time for it to come around and be successful. And if the company, the project is not set up in a way that it can last for 10, 20 years, then it's not going to really take off. At least not in a meaningful way, the way you want it to take off. That's again where the difference between an investor and a CEO comes in, where the CEO is focused on the day-to-day, incremental improvements, improving logistics, improving here and there. Small changes can make a big difference also over the long term. But as an investor, you got to think, like, how is this going to be a fortress for 10, 20 years? And the last question brings us back. It's the secret question. Have you identified a unique opportunity that others don't see? So this nicely brings us back to the contrarian thinking, how we started this video. What very important truth do very few people agree with you? You can maybe allow for 1 or 2 questions to be not 100%, and things can still work out, according to Peter Thiel. It can work out, but you should really aim to find investment opportunities that tick all of these boxes and have a great answer to all 7 of these questions. If you'd like to receive this investing framework according to Peter Thiel in a written format, I'd like to recommend and ask you to subscribe to my LinkedIn newsletter, where I will publish an article about these investment steps. That's a great way to engage in the community and share your thoughts about more detailed questions that you may have. If investing in startups is a thing that in general interests you, then definitely check out my other video on this called How to Invest into Startups, and subscribe for more content like this. Thank you for watching.